Ladies and gentlemen, Governor of the Central Bank of Russia, Elvira Nabiullina. Good day. I'm glad to welcome all of you at the International Financial Congress. This year, the theme of the Congress is Financial System, Stability for Growth. This theme has not been chosen by coincidence. More than 10 years has passed since the beginning of the global financial crisis. 10 years has passed, and yet we're unable to state that the world economy has indeed transitioned to sustainable growth rates and is capable of growing on its own without being propped up by stimulating measures. This is certainly a reason to analyze the reasons why the crisis has been so protracted, and it would be premature to make conclusions whether the treatment has turned out to be efficient. I think time will show whether that was the case or not. It is absolutely justified that the responsibility for the financial crisis that has had such protracted and profound consequences for the economy and welfare of people in many countries is blamed to a great extent to inadequate regulation in financial sphere. The regulation, or rather lack thereof, has led to risks piling up, which later translated in the real economy, and due to the globalized nature of the economy, have affected almost all countries, and most heavy blow has been dealt to those countries that had seen their weaknesses, internal weaknesses, pile up. All of this testifies to the fact that the adequacy of regulation and the sustainability, or rather resilience, of regulators to the appeals to loosen the regulation to provide the financial institutions a chance to prop up economic growth, all of that is required in order to avoid sometimes menacing piling up of risks. The response to the crisis was a radical reform of financial regulation. Back then, the need for that was recognized by almost everyone. Tightening the financial regulation has drastically changed the landscape of the financial sector. It was indeed a response to the crisis. It changed the rule of the games, and it decreased the risks of the crisis coming back. As for the loose monetary policy, as is everyone aware, its primary goal was to help the economy and the financial markets stay afloat, to prevent them from sliding into depression. In other words, a loose monetary policy is the policy of adaptation, whereas the reform of financial regulation is the reform of change. Certainly, reform on its own is not sufficient. Loose monetary policy was meant to buy time in order to carry out structural reforms in order to rectify internal imbalances. Each and every country had those of their own. Yes, we managed to buy some time, but whether these reforms have been carried out, that's another question. We see low productivity, low investment and indebtedness in many countries, and we can see that there is talk about a new crisis popping up everywhere. The imbalances piling up are too strong, and the monetary policy is not omnipotent. So after the acute phase of the crisis, we saw a period of low growth rate. And only last year, as we can see, the economy started to crawl out from this state. The growth rate hit almost 4%. Unemployment reached a minimum over the last 4 to 5 decades. But as we can see, this growth was carried out with stimulating measures of monetary policy still carried out, like the ECB, which is still purchasing assets. And right now is high time we discussed what lessons we can draw from the post-crisis decade. Even though the indicators of productivity and investment do not give us a chance to say that the crisis has had a purifying effect, that the economy has emerged from the crisis stronger than it used to be, still, maybe we did manage to achieve a certain sustainability of the global financial system. What consequences of the crisis are still haunting us? What new problems do we see arising? Maybe these issues in this or that form are asked by regulators both in developed countries and in developing countries. For Russia, whose financial markets, judging by the world criteria, is still very young, we've got many specific issues, many peculiarities, and these issues are as acute as ever. And as the regulating, we can say with confidence that the financial system is more sustainable than it used to be 10 years ago, and even more sustainable than 4 years ago, back in 2014. The question we have to ask ourselves, so that this greater sustainability could become a factor for economic growth, the development of the financial sector and how it's going to facilitate the growth rate which our country so direly requires. All of that is going to be affected by three factors. First, what is going to happen in the global economy. Secondly, whether we'll manage to preserve macroeconomic stability such as low inflation, low debt and a well-balanced budget. And the third factor is the rate of structural reform and the economic growth rates dependent thereon. A little bit, let me elaborate on that a little bit. Last year, the outlook of the world economy was quite good. The inescapability of monetary policy normalization in developed countries results in capital flows which, amid cheap liquidity, were almost decoupled from the fundamentals, are going to seek safe havens of historically risk-free assets, and they will pay greater attention to fundamental weaknesses or, on the contrary, strong suits of certain economies. The growth of interest rates, especially in dollar borrowings, the turn of capital flows, already creates tensions in some economies that are macroeconomically vulnerable. And overall, the volatility of global financial markets is becoming greater. This situation is certainly further aggravated by different political risks, an upsurge of populism, a recrudescence of protectionism, with the risk of fully fledged trade wars, a never more active use of financial sanctions unilaterally. All of these factors create greater risks in financial sectors and result in greater volatility. As the experience shows us, the only thing we can do, a developing country can do in order to face these risks, in order to preserve opportunities for economic growth, is to preserve macroeconomic stability. Lack of imbalances and excessive indebtedness, a healthy financial system and a good cushion of liquidity, all of that is required. And recently the government and the Central Bank of Russia have been paying attention exactly to that. And greater financial risks is all that tells us that we've got not to neglect macroeconomic stability, but on the contrary, to reinforce it. Last year, as we promised back in 2014 when we transitioned to inflation targeting, we for the first time, hit the inflation target. Right now, we've got to secure this result to make low inflation the new normal. So the goal of the central banks of the Central Bank of Russia's monetary policy is to maintain inflation around 4%. As you know, right now there is talk about possible inflation consequences of the new measures of the government. Recently, I spoke exactly on this subject at the St. Petersburg Economic Forum, which was held recently. Let me reiterate once again that our monetary policy is calibrated in such a way that in any case we'll be able to cope with the inflation consequences of these measures. And in certain cases we can see a short-term acceleration of inflation, maybe a little more than 4%, and we do understand that it is not always reasonable to try to avoid that so as not to hurt economic growth. But should we see such deviations, they're not going to be large scale, they're going to be only seen in the short term, and afterwards inflation will get back to 4%. The stabilization of inflation is going to be accompanied by a reduced volatility of interest rates in the country, as the inflation expectations are decreased and anchored. And in terms of anchoring, we still have a very long way to go. As we can see, as of May, there are surges on prices on certain goods, petrol in particular, and the volatility of exchange rate still has an effect on inflation expectations. They have not been anchored yet. As for the government, we believe an important contribution to macroeconomic stability is made by the fiscal rule, because it protects fiscal expenditure from oil price fluctuations, and it gives the budget a chance to fund priority areas on a sustainable basis, and it preserves the stability of other macroeconomic fundamentals such as the real exchange rate, and we can see that in practice. In other words, in terms of macroeconomic background, we do not see significant risks for the financial system and future. Moving on to the economic growth rates, it is evident that the development of financial sector and the economy are intertwined. A confident, a steady economic growth reinforces the financial system and vice versa. When elaborating our monetary policy, we always carry out assessments of potential economic growth, and as we can see, 1.5 to 2% of the economic growth rate that we witness right now amid the unemployment, which hit a record low. Well, these 1.2 to 2% is the economic growth rate our economy can hit in the midterm without changing the structure. As we can see, still business as usual scenario is carried out. We have not been able to overturn the trend, and yet we do hope that concrete measures that the government is going to come up with in order to carry out the presidential decrees, as long as fiscal expenditure is increased in priority areas, all these measures are going to open up opportunities for private investment, for private entrepreneurship. In the end, it will give us a chance to raise the potential of our economic growth rate. Certainly, we understand that these measures are going to reveal their effect step by step, and we've got to take that into account when elaborating our financial steps. What about the overall influence of these external and internal factors for the financial sector? First, so far, low economic growth rate is seen, and we cannot see concrete growth points, and that presents a challenge to the financial sector. The response of the financial sector was a huge upsurge in lending, mortgage lending, and consumer lending. Mortgage lending is the only sphere of lending our country is lagging behind other countries with similar growth rates, but we can see that this is not sustainable because the indebtedness of the population is growing. We'll monitor that, and to prevent the bubbles from forming. The purifying, the cleaning of companies' balances from bad loans will create conditions for greater lending for producing companies, and the financial institutions have to be ready for that, to be able to take to avail themselves of these opportunities. And for that, we need banks to raise their competences in terms of assessing the prospects of new companies, small companies, new projects. They should be able to develop the institutions of project and investment financing. We believe that the financial sector has to become a partner of business in terms of searching for new growth opportunities. New fintech, in particular big data, can play a huge role in developing such competences and qualifications. And as we can see, the government support is mostly targeting those financial institutions that already possess such competences and qualifications. Secondly, the neutralization of monetary policy, which is going to happen very soon, is tantamount to the stop of interest rate going down further. And there is a chance that the interest rates are going to go up should pro-inflationary risks arise. Recently, we've been living amid decreasing interest rates, but it's important that the overturn of this trend should not take the sector by surprise, nor should it lead to excessive risks. We have to think right now how the securities, financial instruments are going to be priced when the interest rates are not moving in one direction anymore. Right now, we can see that low volatility is in the past. The markets are going to see greater volatility, and these risks have to be managed. We're not we shouldn't try to shift it on the end borrower as it sometimes happens, because in the end it will mean greater credit risks for the financial organization itself. And right now it is ever important to construct new instruments taking account of these risks, to hedge these risks. And secondly, the macroeconomic situation as well as the huge progress in fintech will require that the financial sector should manage better its costs, it should optimize its procedures and processes. The change in the business model of financial institutions, which we believe is going to happen under the influence of these factors, should prop up accelerated economic growth rate, and it'll make financial organizations more sustainable in the midterm. In order to spur up this transition, we're going to resort further to stimulating regulation. Stimulating regulation is often contrasted to neutral regulation, saying that using regulation in order to affect the business models of financial institutions could be somewhat not safe for the financial sector. Let's have a look at the banking sector, for instance. When we see a situation when even big banks are used in order to fund almost solely the business of their proprietors, to mostly fund the transactions of mergers and acquisitions instead of financing the real economy. When all that happens, we have to understand that this is the threat to the very stability of the economy. A regulation that would stimulate normal classical banking activity would only be for the best. This is particularly relevant right now when the banking system has recovered and lending in all segments is growing on a steady basis, and this trend is going to be preserved. Lending has to be developed in such a way so as to facilitate economic growth and to prevent society standing to lose from funding inefficient projects. That means that we're going to pursue such a regulatory policy that is going to support a qualitative growth of the market and discourage from practices that can lead to risks piling up. What practices am I referring to? First, we have already taken measures, and we're going to take further measures in order to decrease the share of forex in our balances. We need to make our system less susceptible to deviations of exchange rate. Secondly, secured funding, mortgage financing leads to non-core assets or bad assets piling up in the balances. The fund of non-core assets we are establishing, which is worth around 2 trillion rubles, is the direct consequence of this. When banking lending becomes Lombard lending, it is indifferent to banks whom to give money to. They only need a collateral, and they do not analyze the economic activities of those they give their money to. And that's why the collateral reform, which we are discussing right now, seeks to decrease the share of Lombard lending. It'll stimulate qualitative projects and their funding. That is one of our priorities. Third, the fight against funding of the business of proprietors by banks. This is a fight we've been long waging, and we're going to continue that. The time when such pocket banks existed, never contributing to economic growth, is past. Fourth, sometimes loans are provided to holdings, not to operators. And sometimes the enterprises themselves have to bear the burden of acquisition or merger. This leads to greater indebtedness, and the loan is not funneled into the development of the business. Incidentally, almost all the assets which we got to the foundation of non-core assets are too much indebted. The debt level is very great because the proprietors changed all the time, and this is a vicious circle we have to break. Fifth, as the financial market develops, there is a greater interdependency of financial institutions in different segments, both regulated and non-regulated. Banks, insurance companies, pension funds, professional participants of the securities markets, leasing companies, they flock into groups. Sometimes their relations are formalized in terms of proprietorship and ownership. Sometimes the ties are not formal but sustainable, and malafide players use regulatory arbitrage among sectors and among different financial institutions of one segment, cross-investment, hidden financial support of organizations from another sector, the transfer of risks, transactions in order to conceal the real source of funding from the regulator or the real goal of investment, using the trust in a bank in order to sell massively malafide products. All these factors have to be fought against. First, we need to harmonize our banking and non-banking regulation so as to eliminate regulatory arbitrage, and we've got to reinforce oversight in banking and non-banking sectors, as well as to develop new approaches, as well as the institution of motivated judgment of the regulator. Given the lessons of last year in particular, we want to revisit the concept of our oversight over banking and non-banking holdings. Say if we had powers with regard to the whole holding at Crete and not just the bank, then it would have been much easier to find the assets and get back the assets that were channeled through the holding. Sixth, a just price, the stock market price, preventing the manipulation of the market. It is a whole block of issues that is becoming increasingly relevant in terms of how correct the prices are on securities that we see emerge in the stock market. We see that sometimes prices being manipulated, the shares prices are being expanded. Sometimes there are transactions through the stock market on a collusion basis, and sometimes market mechanisms are taken advantage of. The price can look like it is just, but as a matter of fact, it's not. Another issue is the high concentration of credit risk for one lender or related persons. We know that N6 normative is in force now, and banks can only try to avoid it. Some banks still think that they would be better off if they were the one major or the only lender of that enterprise. But the concentration of these risks is a threat to the sustainability of the banks, and the bank is taken hostage by the client. It has to agree to numerous restructurings. It has to renounce the opportunity of collecting the debt or using the underwriting. So this year we're going to talk with banks about revisiting the approach just to the risks of concentration in terms of the N6 standard, the development of syndicated loans, and we've got the legislative basis for that already in place, further consolidation of the banking sector. These are, as we believe, the right ways to decrease the risks and to increase the bank's sustainability and stability. And lastly, we understand full well that greater regulation at the international level and domestically, as we can see, all of this entails costs for the bank. But in order to decrease the risks to the stability of the financial sector, to get rid of the problems that have piled up, we have to do that. Certainly, we would like to cease to engage in micromanagement, trying to close up lacunae for malafide bankers. The costs for such micromanagement are transferred to the bona fide participants of the market. But we believe this will not be possible as long as the responsibility for such infractions in the financial market is very low, as long as bankers, malafide bankers, know that they can hide abroad and they still have possession of their non-banking assets. Say, over the 4 years, the criminal articles on falsified financial reports, only 4 persons have been held to account, and around 30 criminal proceedings have been initiated. But we believe this responsibility has to be tightened. And oversight is also important. This is the first time we raise this issue. We understand that without the right of motivated judgment, we're also going to lag behind, trying to catch up. We'll have to formally try to argument to justify any infraction to prove it. We see malafide participants finding a new loop. We have to remove it, and it is a vicious circle. Oversight is going to be better, and the damages for society would be lower if we had the right of motivated judgment. Greater responsibility of proprietors, of managers, will lead to lower costs in management and oversight. It'll also create conditions for a real consultative oversight, as well as for fostering partnership relations between the regulator and the bona fide banks. From regulation, I'd like to briefly move on to another important topic, which is the competition in the banking sector. It is going to be in the spotlight of the Central Bank of Russia. I'd like to say that we're convinced the quality of competition is not directly dependent on the number of banks. Yes, there are many banks that have seen their license revoked, but all of them distorted the competition, being engaged in illegal operations. They funded their own proprietors and used borrowing and new assets, and not in good faith. But the banks that still work in good faith. They stick to the rules. Playing by the rules is the basis for just competition. It is important that this market competition should be efficient within different banks and financial organizations, and that is why banks and financial institutions have to find their own niches. Small banks without any support will see it hard to endure competition, and in order to support this competition, we have come up with the concept of proportional regulation. 2018, let me remind you, is the time when banks with capital of less than 1 billion rubles are going to get a basic license. We have 192 banks like that. The assets combined account for just around 1% of the financial system. These are small banks. We're going to support the institution of small regional banks because these credit organizations can provide a high-quality service to such an important segment of the economy as individual entrepreneurs and small businesses. The reporting regulation for these banks are simplified for them to be able to concentrate on this segment. Moving on to improving the financial system, the cleanup, we also seek to improve the situation there. Until recently, among the systemically important banks, we saw some institutions that suffered losses of liquidity, that distorted the competition and weakened significantly the banking sector. Since summer last year, we used the new cleanup mechanism for the biggest banks on a temporary basis. We became the controlling shareholder of those banks, temporarily operating them, and right now I can say that this new cleanup mechanism provides us with a chance to just in 6 months, not in 10 to 15 years as it used to be the case in the past, to improve and recover the bank or a financial group without any risk of destabilizing the financial system. As of now, the 3 biggest banks which we included into this cleanup mechanism with the help of the fund are fully recapitalized and they provide services to their clients. We managed to provide their continuity, restructured non-core and problematic assets, developed strategies for their development, giving the potential and role they can play in the economy. In other words, the larger part of the work to improve the work of the biggest players of our banking system is over. And the bank seeks to, as greatly as possible, get back the assets that were allocated for the improvement of the financial system. in particular through compelling the former proprietors to make up for the damages, to make them get back the assets they transferred abroad. Unfortunately, the only mechanism we have right now is the collection of debt through court. We come up with the mechanism of subsidiary responsibility and liability. So far, this concept of ours hasn't been accepted by our colleagues, but we're going to work with that. We also work with lawsuits against former proprietors, and very soon we'll see new legislative amendments as to how these damages are calculated. There are two mechanisms we propose that should be discussed. First, freezing the assets worth the claims during the trial so that these assets are not liquidated or transferred abroad. And the second mechanism is also seizing the assets of managers until the trial is over. Unfortunately, the fleeing of managers abroad and proprietors abroad, where they recover their assets, this is something we still witness. But I'd like to conclude on a more optimistic note, even though I have to talk about the unpleasant things and challenges we are faced up against and we have to work with. But still, there is ground for optimism, because as I've told you, the banking sector is stable, it is developing, the profits are good, there are opportunities growing for lending and its development. Indeed, we believe that in the course of the banking sector cleanup, the major number of malafide banks have already been pushed from the market. And right now, we have a chance, on the one hand, to expect that there are going to be fewer cases, insurance cases for insurance companies. On the other hand, we can expand the opportunities of the deposit insurance system, because we've already emerged from the situation many banks have told us about, when bona fide banks have to pay for the malafide ones. We believe that the deposit insurance system can be expanded in order to prop up the trust of citizens and business and the banks. We believe we've got to accelerate the adoption of a law on insurance of some legal entities, small legal entities, small enterprises and individuals. We believe that we've got to raise the sum of the compensation in those cases when the deposit holders have no power over problems, when heritage is given, when a flat is sold or purchased, when social benefits pile up, when there is a sum greater than 1,400,000 deposited and insured. And in these cases, the insured sum can be raised, and this is a project we're working on together with the Deposit Insurance Agency. And this agency, after a social discussion of contesting transaction when credit organizations are bankrupted, and these problems have been ever as acute. And in light of that, it has been proposed that the sum is raised within which the compensation is not going to be contested should a credit organization go bankrupt, and this sum, as is proposed, should be raised to 10 million rubles, and we support this proposal. Now, we mostly talk about the banking sector, but let me say a couple of words about the non-banking sector. I know that yesterday there were some productive discussions, and in the sidelines of the Congress, these issues are going to be discussed even further. So just let me outline our vision for the development of non-banking organizations. This year, we see the completion of the first phase of the single strategy for the financial market. Tomorrow, during the plenary session, we're going to talk about the vision for the next 3 years, and we can already take stock of some results. Over the period that we've seen, we've concentrated mostly on cleaning up the market. We had a huge program, the Clean Register, and we pushed from the market companies that were not involved in real operations, that were involved in malafide or legal operations. We reinforced the regulation where it didn't manage to live up to the level of risks. We introduced the institution of guaranteeing pension accumulations and reinforced oversight in some areas, as well as took special measures to stabilize the obligatory car holders' liabilities insurance. We have also been working on developing the bond market, and as we can see, it is developing quite dynamically. On the whole, we're confident in the long-term sustainability of the financial sector and different segments thereof. We are also confident that our oversight will be able to reduce the risks of possible ramifications of problems should they arise in certain segments or sectors of the market. Right now the situation is quite stable and interest rates are going down. It means that consumers search for greater profitability. They're becoming increasingly interested in instruments alternative to deposits, and we see this interest rise up. And the centerpiece of our strategy has to be the consumer, it's their interests and protection against excessive risks. Trust, the confidence, should be the ideological foundation, as it were, of the financial market development. And as for the strategy for the next 3 years, we have certain guidelines. First, we'd like to raise the competition and financial inclusion based on the fintech and infrastructure solutions, such as remote identification for the consumers of financial services. And that means that financial inclusion is going to be greater. The competition of the market is going to be greater because the role of traditional restrictive factors is going to be not that great. It's going to be less. The marketplace, it's a prototype which we're going to demonstrate today as one of the steps in order to expand financial inclusion, to provide access to new markets for financial organizations. Secondly, reinforcing the atmosphere of trust in the financial market, protecting the rights of consumers. We want citizens and companies to have trust in financial institutions. We're going to eliminate mis-selling and malafide sales, and we also create a special behavioral monitoring because we wouldn't like the citizens to be disappointed in the financial products they purchase. We're also going to improve the institution of business reputation and qualitative management. One of our forthcoming tasks is creating trust. As you know, a law has been recently adopted to create the institution of a financial ombudsman. Reinforcing these standards is also very important. The standards every participant of the market sticks to, and the role of self-regulating organizations is great in that regard. Right now, standards are being elaborated in most segments of the financial market by self-regulating organizations that take an active part in elaborating and promoting these standards, and they will also be responsible for these standards being upheld. Now, moving closer to the conclusion of my address, I'd like to say a couple of words about some difficult tasks we are facing. Every year at the Financial Congress, we're trying to provide you and the market with all information about how we assess the situation, how our priorities are set up, what novelties we are going to implement. Theoretically, my address every year has to become ever briefer because regulation has to be more sustainable, the rate of innovations has to be smaller, but there are some themes we are revisiting every year. We did that a year ago, 2 years ago. Unfortunately, some issues have turned out to be protracted. I've touched upon some of them, and I'd like to assure you that everything that is not yet complete, we're going to accomplish. I mentioned almost all of them, but the implementation of pension capital is the last thing I'd like to mention. It is critically important to the pensioners and to the economy. We believe this institution is viable, and we will work with the lawmakers for it to be adopted as soon as possible. I'd like to wish you interesting work during the Congress. I'd like to wish you that you stand to benefit practically from the discussions that are going to be unfolding here, and I wish you optimism despite the issues we're talking about. And this is something we have to talk about in order to move forward to remove these issues. Despite the problems we have, there are grounds to have an optimistic outlook at the financial sector development, as well as at the role of the financial sector in the development of the economy. We have gone a great way in overcoming financial difficulties, and it's high time financial industry contributed ever greater to the development of the economy, to raising the economic growth rate. I'd like to thank you for the attention, and without a break, let us move on to our panel discussion. I'd like to invite all the participants of the first panel session here to the podium.